Scenes.
All right, we're live on both channels. Perfect. So we're live on
Yes.
on Instagram. I'm here with Harold Valestin, real estate investor, real estate broker, real estate uh,
Motivator, coach,
motivator.
you name
Real
it.
estate has been his life for what the past at least 25
Almost 20
years.
years. So yeah, in a way, yes, because I started with my brother kind of just being kind of his apprentice in a way, working with him in the management company and doing stuff like that. And then I got my real estate license in 2002 and started investing on my own in 2006. And here we are. Got crazy in 2008, and obviously dealt with what everybody dealt with. Was able to keep one of the properties that I bought, and then had to rebuild. And now we're moving along. We're doing some things.
Awesome. So just to kind of go into this, and this is for everybody on Instagram, YouTube as well. My name is Carl Pierre. I am the, I guess, founder, creator of ENTP Life. On ENTP Life, we mostly talk about investing in real estate and my other business ventures. The idea is really to give everybody who has like a life dream to kind of break free from the rat race a pathway to do so, a way to replace your 9-to-5 income so that you could go out there and live your dreams. So on this channel, I pretty much cover all the little hacks that I do to make money. Some of them are quite large, like my home care company and healthcare staffing. That's probably the biggest chunk of things.
Very
Followed
large
by,
people. Just listen to him.
followed by a multi-million-dollar real estate portfolio that grows annually, and everything else that I do. So whenever I kind of try something new, like Airbnb businesses, or I just started Turo, I'm going to be featuring that on the channel as well. I try to share what's working for me and how you guys could kind of do what I do if it resonates with you. All right. I've done some investing internationally. I have two properties in Italy that I bought, one for 5,000 euros, other for 12,000. I'm now actually heading this weekend down to Cabo Frio, Brazil, to handle a land acquisition there. And that's kind of what I'm more interested in these days anyway, like some of the international stuff. But that's the long and short about me. This week's episode, I featured a project that I did as a group investment. I have my program, Killing the American Dream, which teaches people how to invest in 1-to-4 family real estate the way that I do it, right? So I have both a flipping strategy and mostly a buy and hold strategy. So a lot of friends, people that I know have asked me, Carl, how did you start? How do you do it? So I created a course so that they could say, hey, sign up, check it out. This is how it gets done. So part of that course, I decided to create an invest and learn option. That invest and learn track allows people who are in my course to put up money alongside me in a deal. And they get hands-on kind of mentoring and they get exposure to the deal. So unlike some other people that potentially just charge for mentoring, I prefer to get people involved who are serious. And my way of testing if they're serious or not is if they're ready to invest, right? So if they invest in the deal alongside me, they benefit in a few ways. They are sharing the risk amongst the people who are in the group and me, and they're benefiting from direct mentoring and exposure without doing it on their own. At the end of it all, as long as we turn a profit, they make money. If we lose money, they don't lose all their money. Like I haven't had a flip that's gone to zero yet. So the risk of loss is fairly low. The risk of total loss is almost zero. And there's a lot to be learned in that situation. So rather than paying for guidance, you're paying to be in a deal and learning at the same time. So that's why it's the invest and learn. So we did our first deal in Hillsdale, New Jersey, Bergen County. Successfully exited that deal. Didn't make as much money as we would have liked to make just because construction ran a little more than we were expecting. We were dealing with pandemic times. Even though the market is pretty good now for sellers, there was still a little uncertainty in the marketplace. But we did okay, right? We made some money. Everybody learned something. And actually, one of the people yesterday said he's glad that he went through it, even though we didn't make much on the deal. It gave him such a good sense of what flipping is like. And I actually sold him a property, a 2-family property years ago. And he was like, I actually would rather buy turnkey, right? Because his property cash flows, his experience has been good. And he's like, now he knows that flipping independently is not for him. Too many moving parts, too many things. His buy and hold strategy is preferred for him, or preferable. And he turned around, he made a little bit of money at the same time, and now he knows what's not for him. So everybody is going to get what they get out of the program. Today's special guest is Harold Valestin. I gave you a little introduction as to who he is. Basically family to me. He went to school with my older brother, grew up together, and we've always bounced around our entrepreneurial ideas. He's just like me. If he sees opportunity, he goes for it. Whether it's like one of his obscure hustles was selling e-cigarettes at one point, right? When those were picking up. So if he sees opportunity, he goes for it. I was selling lollipops in high school just because lollipops in the hood weren't available to the students that were in my schools, and there was a little bit of money to be made. So it just shows you what kind of people we are and why there's been, decades of synergy around real estate.
Yeah, and what's funny is, and that's so everybody who's on Instagram, we're simulcasting. He's on his YouTube channel. I'm on my IG channel. Just so if you wonder why there's like multiple looks here, I'm looking down, looking up, this, that, and the other. But just to give you guys a funny story about those lollipops, he made it so cool to have these lollipops at the school. Mind you, he went to my alma mater as well, that they banned the lollipops from the school because everybody had them in their mouth. Like if you didn't have them, you were cool. So that's how crazy it is. I mean, and then he's following our footsteps because we made it illegal because we had a little business of bringing in outside food because the cafeteria food was so bad. We used to bring outside food. We used to basically we would DoorDash before there was DoorDash. You know what I mean? So we would get the food, we would bring it in, and we would put a little markup. So for like a $5 plate of Chinese food, we charged $7. We made a $2 markup, and we were doing so many numbers that they're like, where's all this food coming from? And they shut us down, but it is what it is. They were hating.
And those are things. It's like if you start early, there's a lot of lessons that are learned along the way, and I think that's one of the best things about working with somebody who's a little more experienced. And I kind of want the live to be focused on really what we've done so far in our real estate investing careers, and how we work with people of various experience levels to execute the type of deals that we're going to do. One of the big things that I learned, maybe, I don't know, it's probably around 2010, 2011. I met with a real estate investor. At the time, he had about $250 million of real estate in New York. And he met with me to kind of give me advice. I went looking for money. He gave me advice. So his advice was, you can't expect somebody who has a pie of pizza to give you their whole pie, right? It's going to be a lot easier to convince them to give you a slice. And if you convince enough people to give you a slice, you have your whole pie of pizza and you have a really nice meal. So that kind of stuck with me. It's a very simple analogy, but you can make money on a deal by just having a slice of it. And if you expose yourself to enough slices and you do enough smaller deals or partnerships, you eventually will amass what you're looking for, right? And it's going to be a lot easier to get there in slices and in bites than all at once your first deal, right? And a lot of, especially people who are kind of have the potential for envisioning the future, we think single family home to skyscraper in 6 months, right? And it doesn't work like that in this world. So we want to talk about what our experiences have been.
Though we wanted to.
We wanted to, but skyscraper money is going to be institutional in nature. And institutional money really counts on track record and relationships more than anything, right? You could have the perfect vision for what you want to do, but if you've never done it before and you have nobody vouching for you, no one's going to put millions of dollars behind your idea, even if it's perfect, right? You're going to need to prove what you've done lately. You're going to need to prove that there's traction behind what you do. So If you if you can, Harold, I know that you're working
Yeah.
on a deal now that I think is quite interesting, and it's similar to more of the type of real estate investing that I want to do. I've been investing in 1 to 4 family for what 15 years now, and I want to get more and more into kind of commercial residential real estate, which is 5 units and more. Now you're working on a group project. He does similar things, group investing, getting other people involved. It's really just the best
Invest and
way to
learn
go about it.
was my coin phrase, but I let him borrow it.
Yeah. We spoke about it, and yeah, I ran with it. So um, like invest and learn and earn and learn. We were throwing around ideas as to what makes sense, and yeah,
Yeah.
so that's what it is. But
Yeah.
he's working on a pretty cool project in Chicago, and it falls into that multifamily range, that 5 units and more. So the first thing that I want to talk to you about is really what changes above 4 units, and
So
why are they in different classes?
so once you cross over to 4 units, it's considered commercial multifamily, right? In commercial, people think hear the word commercial, they think office buildings, they think hotels, they think other things. But commercial for lending standards is anything 5 units or above, and it starts to get a lot trickier and a lot more expensive once you get up there, because there's a different way of how they analyze the property. So where in the 1 to 4 family, we're looking at comps, right? What sold next door, what sold down the block, what sold 6 mile, a mile radius around the property. On the commercial side, they're looking at that, but they also want to look at what kind of revenue, what kind of cash flow that building is generating to create that opportunity for them to see if it's worthwhile investment. So it's not just how much the building is worth, it's how much is the business within the building, that's my phrase, that is worth. So that's what they're looking at, is really the business of the building. What is the business of the building doing, and what kind of numbers is it generating, and it's worthwhile. And one of the key things they look at is what's called their DCH, or there's different words, DCR, debt coverage ratio, right? Basically meaning, does the cash flow, is there enough cash flow times a certain percentage, depending on each lender, enough to cover the debt that they're about to give you and still have cash flow just in case. You know what I mean? So
Gotcha.
those are like on a small nutshell, on a high level, that's what that is.
Right. And I'll add a little bit to that. So 1 to 4 family real estate is like the basically you're gaining value in one way. You're forcing appreciation through improving the property to market standards, right? So you're usually buying a dog of a property, right? Either it's small and crappy or just crappy in general. You're bringing it to current standards, and the value that you create is based on the amount of money and effort you put in to renovate that property to market standards, right? And that house is going to be capped more or less to the market, right? So the pricing and the value of that house is going to be set directly to comparable sales. And that's your only way of forcing value there. But as Harold mentioned, the calculations are a little bit different once you go above 5 units, because it's now looked at as a business. And all businesses are valued on one thing and one thing alone, and that's cash flow, right? So once you get over 5 families, you could raise the value of that asset by forcing appreciation through renovations and repairs, right? Buying a dog and fixing it up, as well as improving the operating income of that property. That could be reducing your expenses, only reducing your
Just
expenses.
about to say that.
Yeah, only reducing your expenses, and then the value goes up because your operating income and profits go up, or raising your rents, or both, right? So if you move a property from making $70,000 a year in profits to $85,000 a year profit, then you've just raised its value by 20%. Right. So those are the things that the bankers are looking at, and that's what's driving it. So you could get way more creative with commercial real estate when it comes to increasing values. And it's treated differently. And it's really the game that I want to play more, because you get to do so much more in one deal per se. So that's what's really interesting to me about this deal. So what is the deal itself?
So it is a 8 unit multifamily. It is in the Englewood area of Chicago, West Englewood, which is, I won't call it the worst area of Chicago, but it's not the best area. It's right in the middle, right? It's kind of changing now. To give you an idea, they just put a Whole Foods about a mile and a half away from where this property is at. We all know the game when they start putting Whole Foods in neighborhoods. Acquisition was just such a big opportunity because it was the last owner let the property go to crap, got in trouble with the city, got foreclosed on. So there's a lot of negatives, right, for most people to look at. But it was exciting for me because I saw what could be once it was rehabbed and done. And I did, obviously did the calculations what the cash flow would be and things of that nature. So it's one of those deals where it's going to actually cost me more to rehab it than it is to acquire it. But it doesn't matter because the numbers make so much sense on that.
So let's talk about the numbers a bit. What is the purchase price of that property?
Purchase price is a little over $100,000.
And it's 8 doors, right? So 8 units.
8 doors, yep.
So that's what, like about 15K a unit?
Just about, and which is rare. Which most lenders are like, huh? What? Where? So just so everybody knows, most lenders are looking for 50K a door. So sometimes you got to get a little more creative with these type of deals because of the fact that most lenders are looking for that number. Now, for instance, once I complete it and we're gonna refi it, I got 0 issues, and I can go to like probably a couple thousand lenders because I'm gonna be above $70,000 a door. But the way it is currently, you got to be a little more creative and have somebody who has the vision like you do and willing to take those type of risks along with you.
Gotcha. Okay, so it's 100 and change, right? About $15,000 a door. And how much are you expecting to have to push into it to get it renovated?
Just about $250,000, give or take.
Okay.
When I did when we did the scope of work, I think it was like at 252, 253. That's including contingencies. I'm thinking around 250 should be straight. Obviously, God willing, everything goes well. The blessing that I have is that in Chicago, I'm allowed to use steel for framing instead of lumber or aluminum because else those numbers would go up based on the recent lumber cost. So I'm going to put inside of my permitting and all that stuff that we're using metal for the framing.
Gotcha.
And they actually prefer that because of the fire rating of the metal versus wood, especially in a multifamily, commercial multifamily.
Gotcha. Okay. Now, I actually have some pictures of the deal. Let me pull up some pictures here so you guys could see what we're looking at. And for those of you who are just joining, make sure you slap a like on this video because the more engaged you are with the content, liking, sharing, etc., the more YouTube is going to push this out to other people. So I see 16 folks here. I'm not sure how many of you liked it, but if you're here, slap the like button. Those of you guys on Instagram, I'm pretty sure it kind of works the same way. So show some love and kind of let's get this word out.
Thumbs up, heads up. You know what it is.
Okay, so let's see here. Can everybody see the property itself? The pictures that I have?
Photos, yeah.
So this looks like
I'm saying everybody on Instagram. He's showing this on YouTube right now. You can see this on my YouTube channel later. So if you're not following me, go on it. But you'll see some of the photos of the property as is currently. Awesome.
So this looks like, just based on what's in the house, like the cast iron radiators, this doorknob, skeleton key doorknob. I'm guessing this is built between like 1920 and 1940. Or even earlier.
1906. It may have been
1906. Jeez.
I think
so. 1906. All right. So this is 115 years old as a building.
Actually, I'll tell the exact date in 2 seconds. Hold on, everybody.
So
I'll tell you right now.
Based on it, it looks pretty good. I see that they've had some electrical upgrades over the years. They have like these surface conduits, which means they may have moved away from like knob and tube electrical to some sort of copper wiring. That's not knob and tube. The floors are actually hardwood, and those could be refinished from what I could see here. The walls are plaster. They could be scraped and compounded. So I'm guessing you don't plan on gutting this out, right?
To some degree, I am. So not super gut. So like, let's say for instance, these radiators are going. We're gonna put in forced hot air to push that to the tenants. We may change this. So if you guys can't really tell by these pictures, but the size of these apartments, we may be able to add another bedroom. I'm hoping that the city allows me to do that. If that's the case, my basic numbers, my conservative numbers go up by about 10-15%, which obviously the better that I can operate the building at from a revenue standpoint, the better the numbers will look to the banks and things of that nature, and the more we cash flow, right? So for those who, and it's probably some people on this line that are in with me on this deal, that they'll be happy about that as well, because the better I can generate revenue, the better return they're getting every on their monthly equity stake.
Gotcha. So you're changing out the heating system, right? And you said something that I don't want to gloss over. You said that you want to pass on that expense to the tenants.
100%.
It may sound like a jerky thing to say, but this was something I was covering in my course yesterday, right? When we kind of do our group talks. You want properties that you could pass the utilities on to the tenants. Okay. One, they're going to be accountable for it. It's going to be their cost, right? Yep. And since it's not on you, they're not going to abuse the heat, right? They're going to use the heat the way that they want the heat to, right? Rather than cranking it and it's your expense. But since commercial residential real estate is all about the operating income, if you take your oil bill away, right, because you're not responsible for the heat or the hot water or anything that's burning fossil fuels, and you pass that on to the tenant, that expense goes away and your operating income increases and your property value increases, right? It's a small little hack that you could do to raise the property value just by eliminating your heat cost. If you had, for some reason, shared electrical, right, because there's only one electrical meter and you can't legally kind of parse it out. If you do it this way, now electricity is on the tenant. So that's what he meant by I'm putting the heat or the HVAC onto the tenant. So that's his strategy.
Let me break that number down for you so you understand why I'm doing it. So when I looked at the former kind of numbers before this guy he or she let this property go to this, so my pro forma or my cash flow would be negative $9,000 a year because of that central boiler. So I'm losing $9,000 of profit because of having a central boiler and providing the heat. So why would I want to do that? I want to take that $9,000 back. I'm going to use that $9,000 to build out all those heaters. And now I'll actually get a return for that $9,000 instead of losing $9,000 every year.
So what does that actually translate to property value? That $9,000.
Just so everybody knows, that $9,000 extra of net cash flow adds about a 90 to 100 grand difference in my property value.
Right. So chances are the boiler that's already there is old, beat up. The heating system is old and beat up. He's making an upgrade that's going to come out of his renovations budget that reduces his expense and raises his property value, right? Let's just say it cost him, I don't know, $10,000 per unit, let's just say, right, to do this. And it's 8 units. He still had a net effect or net increase of 10,000. It's probably going to cost him less than $10,000 a unit. But yeah. But let's just say that was the case. There will still be a net value add for him, right? And at the same time, he's no longer exposed to the risk of them running wild on the heat, right?
And just everybody remember what I said. Where I said this property is, it's in Chicago. So you all know it's cold from October to about now. So there's no way I'm taking on that burden. And understand things, folks, that when you do renovations, the renovations you're doing, you're not doing them just because. Every renovation should have a return on investment. Everything you do in any property, but particularly commercial properties, should have a return on investment. So, for instance, I'm changing the heating system. I'm updating the electric, which in turns will make them happier, but won't I won't get violations on the building. I'm redoing the roof, which then in turns saves me costs on certain things there. I'm redoing the lighting, which makes people feel more safe in their environment, and they want to live in my building. I'm landscaping to make it look nice. These all have a return on investment because it's also going to add to my value. When they look at it from the asset itself, and then from the revenue, it'll continue to give me bonus points. We'll call it.
Gotcha. I'm looking at some of these pictures, and aside from the mess, the house doesn't look that bad. Like even this
The top
bathroom,
floors. Only the top floors are messed up because he let it
because of the roof.
leak.
Gotcha. Yeah, I saw those warped up. Like these floors, they painted them black. They don't look bad actually. They look kind of cool. That bathroom is even not that bad. It's just a toilet is off. Sometimes these older buildings are kind of like bulletproof in a way, right?
Yeah.
So
yeah, there's that top floor.
Yeah, there's that top floor that has the water damage, but it looks like the lower units aren't that bad, right? So you got to redo some drywall. And this is something that if you're not used to flipping real estate or doing construction, you might walk into something like this and think, oh my God, it looks like a bomb hit it. To me, it doesn't look that bad at all. It looks like there's a lot that you can salvage and actually improve. And the end user for this property is who? Like what's the profile of the tenant that you play?
Well, right now it's currently set up as 4 2-beds, 4 1-beds. So if that stays the same, okay, it is what it is, and we'll work with that. But my numbers are based just on that, so which is great, and it works beautifully that way. If I'm allowed to upgrade the bedrooms, and the make it a 3-bedroom, and then the 1 or 2 bedroom, holy cow, this increases. So now I'm looking at mostly families, right? Or maybe even a single individual who can afford a 2-bedroom and wants kind of a home office situation. I'm hoping to keep it affordable. So I'm definitely going to have some Section 8 or program tenants in the property, and then look for some other things as well. But yeah, because of the changes that's going on in that area, this is definitely a hold. And I'm looking at years down the line, because currently, just everybody knows the way investors, banks, everybody looks at the value of a property. They call it the cap rate, right? And the more riskier the location, the higher the cap rate, because they expect to get a higher return for that risk. So in this case, this area right now is considered what's called a 10 cap, 10% capitalization rate. Cool. But that is still good for me. But let's say the area starts to change and they start to get better, and that Whole Foods starts changing things around. There's less risk considered to the bank. Now, if I can get down to an 8 cap or a 7 cap or a 5 cap, just so you know how this works, I divide that percentage into my net operating income. And the smaller the number, the higher my value. Just so everybody know. So sometimes you hear, oh, that's a 10 cap. That's great. Yes and no. If you're buying it as a 10 cap, and you can't change the numbers around any bit, not so good. In this case, I'm buying it messed up. I'm creating value, and I'm getting the 10 cap, and then eventually down the line, hopefully sooner than later, it'll come down to, like, again, a 7, a 6, a 5. Like the best part of Chicago is a 4 cap, 4 and 5 cap, which means, just so everybody knows, just to make it easy, if it generates $100,000 a year in net operating income, and you divide that by 5, you have a $5 million building. Right there. You know what I mean? So, yeah, I'm doing my math right. I think I did my math right? Yeah. Or is that $2 million building? Excuse me. $2 million building. I was getting excited for a second. It's a $2 million building. So, yeah. But like, listen, if right now, let's say at some point that building becomes a 5 cap, 10, 15 years down the line, I got I'm into the building for $350,000. Let's even say $400 just for closing costs and all kind of crazy stuff. But later on, it has a net, it has a value of $2 million. I can live with that. I can live with that just fine. Because when it's
And
completed, it's still going to be worth about six to 700,000.
gotcha. I hope this is making sense to those who are tuning in. I have a comment from Mel of Syllabel. Always check the city planning, another base on how your property value will go high. So
That's a good comment.
is there anything that you've seen that's taking place on like the
Yes.
the zoning board or the city planning that excites you, right? So looking at key retailers moving in, especially that are kind of more premium brands, is a good thing. What else is going on in the area that makes this
So
a little
is
exciting?
it has also been deemed a redevelopment zone by the city. So just so everyone knows, when a area is deemed a redevelopment zone, the city means they're going to put money behind getting that area fixed up, cleaned up, putting in new infrastructure, new amenities that makes the area more desirable. So and that's an exciting situation. So especially now with the threat of capital gains tax, a lot of opportunity zones. And shameless plug, I'm starting one myself and should be ready in July to September at some point. Those areas are getting, those funds are getting money like thrown at them right now because people want to offset their capital gains and don't have to worry about them from the Biden administration and what they're thinking about doing to capital gains as well as 1031 exchanges and things of that nature. So these areas like ride the wave, even if you can't do an opportunity zone fund yourself because you don't have the capital gains, but you can invest in an opportunity zone and all boats will rise with the tide.
Right. And for more clarification, because that's a whole separate topic, I did a
Yeah.
video on opportunity zones and opportunity zone funds and what the tax incentives are and how you would utilize that vehicle to benefit from the opportunity zone designation. Now, there's a question over here on YouTube from Kyle Alexander. Welcome. And thanks for joining us. Is the building completely vacant? Would you still
Yes.
approach it if it was occupied?
So just before I answer that, I want to make sure I'm giving my Instagram folks love. I want to make sure you guys hear me. Y'all can hear me clearly. Thumbs up, hands up. Y'all getting all this. Y'all learning everything that we're putting out here. Even though you can't see the stuff on YouTube, at least you can hear what's going on. And if not, join me on YouTube. Give me a like. Let's get it going. So it's a building. Yes, it's completely vacant. I wanted it like that. And would I still approach it if it wasn't vacant? Yes and no. So it's certain factors that are important to me. If they were program tenants, meaning they were on Section 8, veterans housing, nursing, traveling nurse, anything of those type of things, women's domestic shelter, abuse shelter and things of that nature. Yes. Why? Because then while I'm rehabbing, I'm doing things, I'm still generating revenue from those tenants. Because unfortunately, when a landlord lets a building get to that level, many of the tenants don't want to pay anymore. And I understand why. They're running a slumlord. They're being a slumlord, and that's like, to me, that's just inhumane. You're not supposed to do that. You're providing housing. It's supposed to be clean, livable housing. So if it was occupied, I would come in as the landlord that I am and tell everybody, hey, I'm going to work on your stuff first. Let me clean it out. Let me do everything I need to do. Put you back in. But just so you know, please understand, I got to do construction on the other side. Be patient with me and that type of thing. And as long as they're cool with it, we could work together. If they're free market tenants, it's a little tougher because they have the option, in a sense, of not paying their thing, or they can be belligerent about paying their rent because of the fact that they've been mistreated by the last landlord. So it's a up and down situation. Now, sometimes, like this building, the tenants had to move out because it was deemed unsafe by the city. So by that point, then you got to do what you can do. Just so you guys know, I have to go to court once I acquire this building with the city to show them that I'm gonna fix the problems that the last owner neglected. And I have to when I do the rehab. It's gonna be part of the rehab anyway, so it made sense to me.
Gotcha.
But I'm not afraid of those things. Just so you guys know, I just make my attorney check everything out, make sure everything is cool, and as long as it's nothing crazy. Listen, when you deal with buildings in New York City, that's light work.
Yeah.
and I've watched guys maneuver those things.
What are the tenant laws like in Chicago as far as like if you had to evict somebody, how does it compare to New York?
So obviously this current time is a lot more difficult because of the moratoriums and stuff like that. But in general, it's not as stringent as New York is,
Mm-hmm.
it's not landlord friendly either, right? Because
Gotcha.
again, we're in a major metro area. They don't want homeless people running around. So
Gotcha.
you have to have a legitimate reason to have them out, and you have to give them an opportunity to remedy the situation if you can prove it is their fault that they're not paying. So let's say if the heat wasn't working because of me, and you don't want to pay, that's fair. But you're supposed to put, like any other tenant, you're supposed to put that in the escrow account so that when everything's working, you pay me back, or
Gotcha.
even if you fix, things of that nature. But some tenants, obviously, they're not going to do that. But if it's deemed that they just don't want to pay because they don't want to pay, and I have proof that I got my documentation or my paperwork is right, they're going to favor for me, but they're going to give them like another 30 days or 60 days to remedy the problem. And if they don't, then the sheriffs will come or marshals and help them exit the building. Stage
Gotcha.
left.
Okay.
Yeah.
That's definitely good to know. Now, when you're going about one of these deals, right? How do you structure your group investments?
So
what's your typical approach? And I'll go into mine, after
yeah.
you.
So like this one here, like I'm creating a new prototype. So I like to do both an equity partnership, which some of my guys are shouting me out there, which I appreciate. Thank you. And then we also, in this case, we may look, if we don't want to go the bank route, we may look to raise debt. So I will do a combination of the two. There's certain percentage of equity that people will share the risk with me, as well as the reward, and then the debt. They're just replacing the bank essentially. That's all they're doing. They're becoming the bank for me. I'm paying them the same interest I would pay my lenders, and they win on that side. They get paid. They get recapitalized once we refinance out. Like if I'm holding it, if I was selling it, then everybody would get paid once it's sold.
Yeah, and just to expand on that, because I kind of like to assume that people don't know what we're talking about, right?
Yeah.
So what he means by equity, right? Because in real estate, there's equity in two forms, right?
Yeah.
So there's equity in the sense of how much value there is in your property between your outstanding mortgage amount and the property value. And there's also the term equity, meaning that person has a share or a stake in that asset itself, right? So like literally they refer to stocks and shares as equity, right? So he's saying that he gives the option to either become an equity partner, become a partner in the deal where you have a share of that property, you share in the initial money required, right? There's always going to be some cash component. Well, most of the time there's going to be a cash component involved into the deal, right? And you're coming in and participating in that cash component. And because of that, you are a partner for a certain percentage of that entire deal. And then the rest is usually in the form of a mortgage or debt. And that's just the bank coming in or private lenders coming in, which could be the public. It could be a hard money lender. It could be a structured bank. It could be whatever. They're lending you money and they don't have ownership of your property, right? They have the rights to potentially repossess the property, but they're not an owner. They don't share in the upside. It doesn't matter. They just care about their interest. So I always get this question from people who are like, hey, how do I get started, right? It's always, I got bad credit and no money. How do I get started? Okay. When you have bad credit and no money, you better have something else, right, of value, right?
100%.
You better. So let's just say you're a construction worker, contractor, right? And you really have a skill, you understand the pricing structure, you've managed real estate redevelopment, real estate remodeling, right? Depending on what level you're at, that is your bargaining chip. Okay. You could even say, hey, I can do this at cost and I'll recover part of my profits on the sale, right? That's my value to the deal. Because you don't have the credit to secure debt and you don't have the cash for the cash component of the deal. So you have to be creative in how you present yourself. Now, when you're somebody with more experience and a track record of success and you're raising money, it's the same sort of conversation, but the value that you bring to the table is your experience and your track record. So when you're just getting started and you don't have enough money, this was a question that was asked on like I did one of those questionnaires on Instagram stories, and one of the questions that was asked to me was, well, how much do you need to get started, right? On average, you're going to need about 30% of the total project cost in cash. Okay. And that's like the safe figure that I say. So if you're doing a project that's going to cost $200,000, you should have at least $60,000 in cash to try to make that deal happen. Why? Most lenders are going to require at least 10 or 15% down for distressed properties, sometimes 20 is really your just in case money. How are you going to service your debt? Maybe you need to front pay or front load constructions and renovations. So no matter what, I always feel like to be safe, you need about 30% of the total project cost in cash. All right. Even if you got a 10% deal where it's 10% financed or 10% cash contribution, 90% finance for the purchase and renovations, you should have 30% still, and you're going to be in a comfortable position. So if you have zero money and bad credit, your dilemma and your first job is to either educate yourself beyond your peers so that you know what the hell's going on in real estate and present some sort of value that you're bringing to the table, that you're sourcing good deals, that you're going to be able to manage the deals. You are going to be able to manage it because you have this relevant experience. And then your priority is to try to convince people to give you 30% cost, right? 30% of it. Chances are those people are going to say, well, how much do you have involved, right? If your answer is zero, you better be a really good salesman, right? You better be able to tell them, explain, hey, listen, I'm broke. I have no money, but here's what I'm willing to do, and I'm going to make it happen. I promise you, my car, I'll even put up my car as, my contribution, right? You could, take my car or whatever the case may be as my piece. And I say that because everybody who's looking at real estate is coming from a different lens, right?
Yeah.
If you have a lot of money and good credit, and you have no education, you're missing a really important part, right? And one of your partners should be the person who understands real estate. If you have money, you have good credit, and you understand real estate, then you're in the best position to do something. And you probably should still share the risk with other people just because you're going to be able to do more with more people, right? If you're somewhere in the middle, you're going to have to kind of make up for what you're lacking. If you're lacking in credit, you're going to need a partner with good credit. Maybe you have the money, you both have this interest in doing real estate, you partner up, they're the credit, you're the cash, you're the know-how. If you have no credit, no money, you better have some expertise or a really good, juicy deal. It could even be like your grandma's house, right? Because you negotiate a really good term with your grandmother. Property values are $400,000. Your grandmother bought the house for $100,000. She's willing to sell it to you at cost, and it's only going to take $100,000 to fix it. I may come in and say, we could do this deal. It's only going to cost me $30,000 or $60,000, and we split the profits, right? Because the profit is going to be 200 grand. You brought me a really good deal. I'll do everything else. So you have to be crafty in how you go about piecing together your deal. So how are you piecing together this deal?
So let me just add something to that real quick before we go into the deal. So just so you guys know, my first property I bought my cousin. So group economics, right? We both put some money down. He had better credit than me. I had some cash. He had a little bit of cash. We put it together and bought a three unit. But then later on, as I was recouping from 2008, 2009, and things of that nature, a lot of my guys, I say, something, like my developers and the guys I work for, I say, yo, can I put some equity and sweat equity into the deal and get a little piece of the deal? And that was a way for me to get in. So I started off. So where do you think I got these ideas from of, hey, put up 10 grand? They're like, yeah, you got 10 grand? I was like, yeah, I'll put up 10 grand. He's like, yeah, put up the 10 grand. I would put up the 10 grand. He would use it for whatever, staging, this, and the other. But I would have a point something % of the deal, or he would say, I'll pay you back with interest. So this is where the idea of Invest and Learn came from, just so you guys know. So I'm not going to take credit for it. But that's how I was learning. I had my skin in the game. I wanted to learn everything. I wanted to soak everything up. And I want to be a fly on the wall, but I want to be involved. And I knew if I had my skin in the game, I'm going to want to be involved, right? But this was a way for me to get started. And this is the way that, over time I started to learn. So there's things that I implement now that I learned from these individuals, that even when I go to areas like a Chicago, when I go to Georgia, or when I soon go to Philly, once I learned a little bit of the nuances in the landscape, I'm going to do things they never thought of, because I'm bringing that New York hustle that I learned from them to these other areas and doing things beyond that sense. So just so you guys know, that's one way to start. If you got a little bit of money, like save a few dollars and get in with everybody. Now, in regards to how I'm setting up this deal, like I said, I have several guys that I end up giving equity to for a percentage of cash, a portion of cash, and then they got a certain percentage depending on the amount. The higher the amount they gave, the higher the percentage became, as from like a value standpoint. So if you put in 10 grand, you got 1%, but if you put in 50 grand, you got a little bit more than, you got more than 1% per 10 grand, right? So it was a little bit different. And then on the debt side, depending if you, and again, right now I'm offering this, I don't know how crazy I'll be. If somebody wants to get involved on the debt side, I'm willing to pay 12% on the debt right now, because normally I pay 8 to 10% with my lenders. I'm doing this because I want to be aggressive and I just want to get this deal done and finished with. So if before this end of this month you want to holler at me and you want to put some debt up on this building, which me and Carl spoke about a little bit, we're willing to put up that kind of capital. More than likely on a possibly monthly, but most likely a quarterly basis, will pay out all interest and things of that nature. But one of the things I'm willing to do with that, if people want to be involved in learning about the process, getting on calls with me, walking the building when I put my video calls and stuff like that, we can do that so that you're learning at the same time. You're investing and you're learning, and you're soaking up some of the things that you may want to do in the future. Me and Carl, the way we think, like we want to have 4 digits, if not 5, of doors by the time we leave this earth. God willing, we'll alive that long. That's that's one of our goals. Some people about a year, I just want 5, 10 doors, 3 doors. But this is for you to learn some of the processes and things that you got to deal with, dealing with the architect. Like in this case, I have to deal with the architect. I must have plans. I must have permits for me to do drawings. I have to submit those. I'm doing a 1 family right now. I had to get permits and drawings because we're changing it from a 2-bedroom, 1 bath to a 4-bedroom, 2 bath. But I had to get the drawings so I can get the permits for that. So listen, I got to appeal to the architect. You know what I'm saying? So we're already, that's where these things become a little more cost prohibitive for the average investor, because now you're talking about sometimes doing permit and doing other stuff not permits, but drawings and stuff before you even break ground or do anything. Or sometimes you got to do what's called environmental studies, because you got to make sure if they had like oil tanks underground, that it's not seeping, it's not creating any problems into the water system. Because banks are going to want to know. If you borrow money from banks, they're going to want to know that, because that becomes an issue. Because if the EPA ever comes after you, the EPA circumvents everybody.
Yeah, and it's going
like
to cost
the IRS. The feds, they circumvent everybody. So these, appraisals cost a little bit more, because they do not just, like I said, the value of the building, but they're doing what's called a cost analysis. So they're going to start doing comps in the area of the rents to make sure the numbers that you came up with your pro forma actually make sense, and it's legit, that you can actually get those numbers. So you got to peel a little bit more for the appraiser. So these are the things that are involved, and hence why I bring on equity partners. One, so that we should all share in this, and then they can learn from me and do this with us. And then listen, the goal is the next one is to be 18 units or 80 units or 50 units. We just missed out on the 28 unit that I found out our friend Flipping and Jay beat me to. But it is what it is. It happens, right? So this is
so I think and I think one thing that we really need to touch on here is he went from 8 to 80 units, right? The logic pretty much stays the same. The workflow pretty much stays the same. What is required is experience and more money, right? And you're able to start scaling. You could probably go from 8 to 25, 25 to 50, 50 to 100, and your story makes sense, right? Every time that you do your next deal, it's slightly larger, right? And manageable for you, because it's just one factor larger, right?
Yeah.
If you were to go from 8 units to try to pick up 1,000 units, you might be able to pull it off. Low probability. And if you're going to pull it off, you're most likely going to have to bring in a managing partner who has the experience of 1,000 units that, at least fills that box. Because when you're talking to smart money,
You have to have a key partner.
Yeah, when you start talking to institutional money or big money, these are just standard things, right? They're looking at your track record, they're looking at your history, they're looking at everything, right? And they're looking to minimize and offset their risk. Because usually institutional money has a mandate from who they raised money from, that they're going to deploy capital at a minimum standard. So you got to check all their boxes. And if they don't check all the boxes, then they could get sued for making a risky investment in something outside of their mandate. So, like even if you're a nice guy, you have a great idea, great deal, hard worker, you might have to scale back your plans or build the right team around you. And sorry to say it, but if you have, like I said, no money, if you have nothing, right? Because this happens, I get these, and it's no offense to anybody, but I get these inquiries where it's like, do you want to partner with me on something? It's like, what
are you bringing to the table?
What are you bringing to the table? I don't want to be your partner. Like, there's nothing for me to gain here. You're bringing absolutely zero. I'm a hard worker. And I'm like, well, guess what? So am I. So there's nothing. You have no deal, no money, no credit, no know-how. You've never done this before. You DM me. Well, let's work together. It's like, on what? Right? It's kind of bizarre, but I've been a little more naive in that way. But I realize, like, the more you pitch people like that, one day somebody's going to take you aside and say, hey, I respect that you're motivated, but your next steps are these. And when you get to this point, and this is always going to be like, anybody who helps you is going to tell you the same thing. Your next step should be 1, 2, and 3. If you execute on 1, 2, and 3, and you get to point 4, call me again. It's at point 4 that I take interest in people like you. I guarantee you, if that person is in the position to invest with you when you get to point 4, because they're going to remember the conversation, they're going to remember the advice that they gave you. And when you deliver on that, they're going to give you a little more respect, and they're going to even feel prideful in helping you get to that step. They're going to back you. That's exactly how I dealt with my first, really the only hard money lenders I deal with, asset-based lending. I went to them with, this is a great story. I went to them with a deal in Harlem, right? This was a brownstone shell that was going to cost $800,000, $400,000 renovation, right? After repair value, 1.6, right? At that time. Now they're, 2.25. I went to them and I said, hey, this is the deal that I have. And it was going to be my first deal with them, right? It was going to be my third property, but my first deal, like, kind of flipping. So I had no track record flipping. I just did FHA 2 or 3K, regular acquisitions, buying at retail, that sort of thing. And in talking to them, they're like, yeah, that sounds good. They were kind of giving me pushback. And then finally, Dan, who's one of the principals there, he said, Carl, man, I like the deal. I do like it, but we only have $4 million under management, right? They had just gotten started. And they said, this deal is too big because it represents more than 25% of the cash that we have. If you sink on this deal, we're sunk as well. He's like, find something in like the $200,000 to $300,000 range, same economics, and we'll do that deal, right? Because we don't want to be exposed for too much. So I turned around, I found a property in Bayshore, we did the deal. And I've probably done over 25 deals with asset-based lending now, easily 5 or 10 million. I don't even know how much in loan origination they've done on me. But our relationship, I got with them when they only had 4 million. They're doing like $60, $70 million of deals per month now. So, right? So you're looking at, or maybe 60 or 70 flips per month. I don't know if it's 60 or 70 million per month. Maybe 60 or 70 deals per month. But they're doing pretty good numbers.
At least 10 million a month.
But my relationship with those lenders are from their early days too, where they had 4 million under management and now 100 million. Right? So all those things kind of lend into what happens next. So when I have a bigger deal or when I need money that kind of falls outside of the parameters, they're more likely to work with me because there's been this track record developed and this understanding of each other's history, right? So these things come to pay you back in the future. You got to learn to take your time. I got a question from Mel. right? Sorry, Mel, that we got you pending here for this long, but we both like to talk, especially me. Okay, so you said our tenants are moving out in October, and we all know it's hard to get new tenants around that time of the year. It's fair. Any suggestions on how to approach this to get tenants fast? Okay. Getting tenants quickly is going to be based on a few things. How many people actually see your advertisement, right? The more eyes, the more potential interest. Pricing, what you're offering are all going to come into play. So if I know that I have a property opening up in October, one thing that I may do is check in with my current tenants if the relationship is good and say, hey, I want to start potentially showing this property in August, right? Especially if it's like a 3-bedroom, 4-bedroom, like a larger house. People are going to be looking for families. They're a little more particular the more units they have. I mean, somebody looking for a 1-bedroom apartment is kind of just price, location, that's it. 3 bedrooms, 4 bedrooms larger, it's a little bit more. So I would go to my tenant and say, hey, I know your lease is up. You're not renewing in October, or I'm not renewing, whatever. I want to start showing the property. Can I start showing the property as long as I have your permission on what days, et cetera? I'll give you some notice. You start advertising that property at least 2 months out, maybe even 3 months out. Because someone who's moving from one house to the next, especially with a family, they're not going to start looking the 15th of the month, right? They're not going to start looking at September 15th. They're probably going to be looking September 1st. And if they've been through it, they know how crazy it could be sometimes to get everything in order in 30 days. They might be looking a little earlier. So at least that 60-day lead time starts getting people in the doors. Make sure you advertise across as many channels as possible.
As many as you can.
Right? That's Craigslist, Zillow, all of the other MLS scrapers. Maybe you work with a broker and agent as well. Get it put a sign in front of the house for rent. Everything that you can do to get as many people interested in that property. And that's pretty much going to be the difference. Do not lower your standards and who you will accept just because you're concerned about filling the space. A horrible, the 1 month that you lose in rent by just accepting the next horrible tenant, it's not worth it, because that horrible tenant is going to destroy your property, not going to pay you rent. You're going to have to pay to evict them. It's going to cost you $20,000, $30,000 for dealing with a horrible tenant because you were just trying to save $2,000 and not pay out of pocket. Make sure that your property is nice. You're talking to people. You're screening for good quality as early as possible, and that's going to be your best bet. Okay, so I hope you're still here and you got that answer. But thanks for asking. Let's go. You had any questions on Instagram, Harold?
Let me see. By the way, Fritz sent his love. He's here to go start his day.
Pepperidge Farm. What's going on?
Yeah.
I guess he's just starting his day over there.
He is. Yep. I had one person ask. I'm a bit muffled. They asked
Gemini Complex. I've seen your name pop up before.
Hey, what's going on? They were saying, "Oh, what do I think about real estate now as we get out of COVID?" Or like because of COVID or whatever the case is. I think real estate's gonna be the same for a while, just so you guys know. There's still a lot of inventory that's not out there, and they need inventory. So I think it's still gonna be, a situation that persists. Will there be a let up? Probably not for a while. Not with the cost of lumber, not with all the stuff. Numbers are going to stay high. You think, and if you really think about it, when people, even when they come off these moratoriums or forbearance and all this kind of stuff, they're still in their houses. It's not like 2008, 2009. So not everybody's going to sell. They don't need to sell. So again, you still have that inventory situation. There's more buyers than there are sellers, and if the interest rates stay as low as they are, people are going to want to buy to take advantage of these interest rates. So yep. I think real estate will be solid for at least another 18 months to 24 months, bare minimum.
Yeah. What's kind of crazy, just to piggyback off of that, I am not comfortable buying more homes right now. And the reason I'm not comfortable with it is I feel like the market is just doesn't make any like I've never been in an environment like this where the government is just pushing money into the economy, where interest rates are ridiculously low, inventory is all wishy-washy, the world doesn't make any sense. And one thing that I'm also noticing that kind of reminds me of the previous collapse is money is getting looser. And because money is getting looser, there's more participation from inexperienced people. And now, like dilapidated properties are selling for prices that there's no spread to make money. Like I sold last year. I sold a property in Weequahic, Newark, New Jersey. I sold that for $315,000 or $320,000, right? But I bought that property for $60,000, renovated it for about 120, got out at 315. Yesterday I got, or maybe the day before yesterday, I got like a wholesaler shooting me, a deal, off-market deal, $190,000 for a dilapidated property in Weequahic, 3 bedrooms. And I was like, well, this is going to cost me 100K plus because all materials are more expensive. Like a simple top freezer fridge that used to sell last year pre-pandemic for $549 are now selling for $850, $900. Right? The side-by-side fridges I used to get for $899, standard side-by-side, I can't find one for cheaper than $1,300. So all these things are getting more expensive. And these properties are selling for prices that there's no money to be made, right? So I don't know, man. I just feel like for me, 1 to 4 family, I'm taking my foot off the gas. You know what I mean? Like I think in 2019, I did about 15 purchases. 2020, I only did three or four. I did Hillsdale, Middletown project. I did my Florida project. I think I did 3 or 4 acquisitions in, pandemic peak. And this year I'm kind of like, I'm not adding anything unless it's so good that, it offsets my fears of what happens if interest rates start to trickle up. What happens if there's, even more shortages on lumber, right? Brazil's not shipping lumber. China's not shipping things. Things are people aren't working. It's so strange right now. So, to lend to what Harold is saying is like this condition can persist for a while just because they can't raise interest rates because that's going to hurt the economy. Already we're seeing inflation and they should raise interest rates, but raising interest rates now kind of will stifle movement, right? Stifle GDP growth, stifle everything. If they change anything, things get kind of funky. So it's like, what happens? Builders aren't going out there. I'm a flipper. I know I feel this way. I'm not going to turn around and start building a new development, not knowing how much lumber is going to be, right? It might take me 6 months to get approval and lumber prices go up another 30%. My entire budget, my entire pro forma is based on one set of construction numbers. And in the end of 6 months, when I get all my approvals, the deal no longer makes sense. Now I'm just sitting on land and approved documents. You get what I'm saying? So it's like,
I was watching, was it EYL, and a young lady said that in Atlanta, there was developers coming back to the buyers saying, we got to charge you 30 grand more than what you signed up for during construction. So luckily, they I guess they left the window in the contract, but they're like, yo, I don't care what you tell me. You can leave the deal. We'll sell it to somebody else, but I can't sell it to you for the number that we originally went at because my costs have gone up and it has to make sense. I can't lose money on this deal. And they were, they're keeping it. I guess they're keeping it. I've never heard that before, but that's how real it's getting with these change of costs and things of that nature. The other aspect I want people to think about also is with the wanting to be part of the investment side. A lot of people are jumping the gun and not doing their numbers. And numbers are numbers are numbers are numbers. They don't lie. So if the number is tight and everything has to work perfectly, which it rarely does, for you to make money, it's not a deal. And what's going to end up happening is we are going to buy your deal on pennies on the dollar. And you're going to do a lot of the work for us. You're going to do the
Check it
demo
out.
for us.
That Weequahic Hick project,
Yeah.
it's already gutted. Some HVAC complete, some plumbing complete, some electrical complete. So what does that tell you? Some dude got in
Someone ran
there,
out of money.
ran out of money, and now they're trying to unload this half-flipped property. But guess what happens when you try to pick up a half-flipped property? Your next electrician, your next plumber, everybody's gonna be like, I don't know what that other guy did. Right? You think
I
that
gotta
the work
redo
is
it.
halfway done? I got to redo this, or I got to price it like it's like I can't make sense of this. I don't trust it. It's not going to pass. They're gonna try to price you for the whole job. So in that price, you might be thinking, and that's kind of an amateur move. You might be thinking, oh, I only have to close up the walls now and get fun. Nope.
Listen, unless
Unless
they
you're the
got crash
electrician
permits,
or
inspections,
you're the
and
permit.
paperwork,
Yeah,
that don't count.
exactly. So yeah, it's just those sort of things. Let me see if there's any other questions.
I'll check on Instagram, see if there's anything, if I missed anything.
Okay, I'm looking to purchase. Oh, here we go. Delonda, I'm looking to purchase
A fixer-upper.
Fear Upper.
Fixer-up.
A fixer. Okay, a fixer upper. Okay, cool. I was trying to make sense of that. I kind to pick up a fixer upper and to hold in Baltimore City without using my money. Can you break down what I should do to obtain my goal? Okay, is your credit good? Have you done this before? Answer those questions. I'll get back to you. Damian Roberts, how much has rehab costs increased since pandemic? I'd easily say 30%. Huh?
Well, lumber went up 300% or 400%, whatever that number was.
Crazy.
And this Gemini, the what you have to figure out. So what he was mentioning. So if you're trying to not bring out your money, that means you need to tie up an amazing deal. So that way you can go to other people and say, hey, I have this deal. I'm willing to pay you debt on it. For instance, you said you want to keep it. So I'm willing to pay you debt of X. But the problem is, even when you have that debt, you still got to pay a monthly nut or a quarterly nut. However, you guys agree to do it. You still have to come out of pocket to some extent, right? So whether you come out less because they're floating the whole amount, which is rare, because they're gonna want a piece of that pie some way somehow, or they're gonna want a piece of the refi, so that way not only are they getting the interest, but they're getting an extra for their risk because they're putting up all the money. What is the win for them, right? For doing that. So it has to be a win-win situation. So if they're letting you keep the property, they're probably going to take all the juice out of it initially, right? And then let you keep the cash flow. But very rarely will they let you keep more than that. At least if I'm putting up all the money, that's kind of how I would look at it.
Gotcha. So okay, another thing here. So Delana, you have a good credit score, right? And you want to do a buy and hold. Here's a few things that you should consider. Okay. Number one, since you haven't done a flip before, you don't have experience, right? Right now, all you're swinging is a good credit score. Since you're swinging a good credit score, and it seems like you're fairly intelligent and hardworking from what you're writing and how you're responding, you seem like you have it together mentally. I think your value add to this is your credit score and your ability to handle like the administrative side of this process, right? Handling the mortgage, interacting with the banks, that sort of thing, maybe scouting out the deals, managing the spreadsheets. You should partner up with a construction guy who has experience, who says they want to flip, but they can't make sense of the administrative part. And a lot of the construction guys, that especially like the guys who are doing deals themselves, like who are actually on the ground repairing homes, they're administratively they're not strong. The two of you will make a good partnership in that you could do the research, finding the property, crunching the numbers, talking to the banks, and he could be your money and the rehab, right? The next thing that you want to consider, and since it's a buy and hold, you want to make sure that your total project cost does not exceed 70%. Reason being, when you go to refi that property, whether you do a season deal or you do kind of these rapid refis that are out now that I tend to use, they're gonna refi your property at maybe 75% loan to value. Okay, So if you're all in on this deal at 70% or less, after fees and all the other junk that comes into your refinance, you're going to be able to fully recapitalize that partner, so he gets his money back, and now your partners on that deal, your partners in sharing that property and the upside. Okay, you get your money back in another 3 months, 6 months. You're at it again with your contractor. You start building out a nice portfolio like that. Maybe in a span of a year or 2 years, you got a couple $1 million of real estate between you. That's a good partnership that you should establish, and that's what I would do if I was in your condition, right? You got the credit, you got the admin skills. Those are valuable things in developing and building a real estate portfolio. Your partner and the gap that you have is going to be the construction and the cash. And if you're dealing with a construction worker that has cash, you might even be dealing with somebody who's illegal, right? They have no social security number. They can't do anything, but they've been doing construction. They've been saving their money. That's the perfect partner for you. There's another question here. Brown sugar, babe. Hi, Carl. Your Fort Lauderdale neighbor here. What's up? Do you think someone like me, new to real estate, would be able to find a duplex or triplex in Fort Lauderdale, or should I look in elsewhere in the country? If you're in Fort Lauderdale, stay in Broward County, right? Maybe you find a duplex in, like, there's parts of Hollywood, like just west of US 1, right? Because everything east of US 1 is a little nicer. Things start getting more expensive as you get closer to the beach. So I was looking at properties that are right on US 1, like 1 block off, right? Because the natural, as people get priced out of east of US 1 and they still want to be close to the beach, which is the main draw down here, they're going to be kind of inching away and west, right? As you go west, it gets kind of sketchy, right? So looking like that Hollywood section, west of US 1, there's duplexes, triplexes, there's quads there, and just crunch the numbers. If the numbers make sense, I think I was looking at properties that were like tries that were selling for like 300, 350, so like 100,000 per unit, 100,000 at 3%. Let's just say you're talking about maybe a monthly obligation of $500 a month. Meanwhile, your rent might be $1,000. Those are good numbers. So I think there is opportunity still here and around the Fort Lauderdale area. You don't have to go somewhere else in the country. You could stay right in Broward County and make sense of the deals.
So I got 2 questions on Instagram.
Sure.
One is, how do you find vacant properties? I've responded jokingly, and seriously at the same time. Find boarded up properties. They tend to be vacant unless you got squatters in there. And then this other gentleman said he was using what's this software? AirDNA and Mashvisor to try to find vacant properties. I mean, there might be something there. I haven't used those, to be honest with you. I just find the stuff that is dilapidated for the most part, but the bones are good. The interior might be messed up, but I'm looking for the good bones, bad interior, and where people are, they have so many violations they can't let people live there, and I'm willing to take care of those. So there's an aspect there.
So another thing I would want to add to that is you could just drive around your neighborhood. Just drive, ride a bicycle, jog, whatever. There's properties that I'm looking at right now in my neighborhood of Coral Ridge, Fort Lauderdale, that have every sign to me of a house that is vacant. I've never seen the lights on during the day or at night. I've never seen the windows open. I've never seen the shades open. The driveway looks beat up. There's overgrown shrubs. Could it be an elderly person? Potentially. But I see neighbors parking in the driveways, like different cars in there. There's nothing consistent. And I'm just keep driving by at different times, waiting to see, is there a light on? Anything, any sign of activity. Another sign is a bunch of mailers all over the front door. Nobody's opened mail in weeks. The grass is overgrown. You drive by a house like that and you see the neighbor outside mowing the lawn. You ask them, is this house vacant? Do you know the owners? There's so many ways for you to identify a vacant house that, if you're just got your eyes open, you could find them, right? And then it becomes tracking people down and trying to make sense of that deal, which takes time. But that's where your opportunities are going to be, is in the distressed properties that other people are ignoring because it's too much work, right? Sometimes I'll drive by houses like that and I'll think, man, I gotta throw that into my deal machine, or I should knock on the door. And I'm like, I'm too busy. And then 4 or 5 months later, I see it's under construction. I look it up, it sold a month ago. And I'm like, well, I was right in that regards, but I missed it. I didn't move on it.
No. So another question, which I answered. So Brad Mahone asked if you or I have ever done a house with, not a house, but a deal with the owner of a property. And yes, I have. So the risk to consider, which she asked as well, is one, make sure that if you're doing a deal with them, that you have something that ties you to the deal and the property. So God forbid they try to pull something funny, you have a lien or something on the property that doesn't allow them to refinance, sell it without paying you first. So there are some risks in that. Excuse me. There's also ways to structure the deal. You gotta be very careful and have an attorney review that, because if you mess up, in some cases, if you don't do it right, you'll make the person lose their home or their property, and that's not the way you want to build a track record. So that's funny, Randy. So one of the things you want to consider is, who you're doing the deal with, what the numbers make. And it's all about the numbers. As long as the numbers make sense and you guys have your paperwork done right, again, there's always going to be risk in any real estate deal. I don't care who, now, is it mitigated? Yes. Or you can mitigate that risk as low as possible, of course, but you just have to be mindful of all things.
Yep.
Have you ever done a deal with an owner before? Carl?
Have I ever done a what?
A deal with like an owner of a property. They still own the property, but you came in and kind of did a deal with them?
No. Every time I've tried to do a deal like that, they either they want too much money or they're just not really in line. And the majority of my deals are actually listed properties, right? So either I get them from wholesalers or they're priced right and I just move on them quickly and I'm comfortable with them being listed. There's a little premium to pay for that, but it's just a time constraint thing. And now, like I said, those numbers are making sense. But you could find, I've been approached by people who like, oh, I got this brownstone in Brooklyn, hasn't been updated in 30 years. Mom bought it for $120,000, $150,000 and don't know what to do. I'm like, listen, I know what to do. Let's talk. And it never pans out into actually working. But those could be really good deals, especially if you're dealing with the right next generation, right? Where somebody who's really motivated to make something happen, and you could really roadmap and say, hey, we do this first deal. Let's just say it's a 120. I don't know, the purchase price. Your mom is agreeable to you doing whatever you want. It's completely rented. She's moved on. It doesn't matter. Whatever. Let's just do this for cost, right? We're not going to sell this property. We're going to fix it up. We're going to push the market value up. We're going to get new tenants in there. And then this is now going to be the reservoir to do the next deals. We're going to get a line of credit on it, and we'll continue doing more accumulation deals together. That way you don't have too much debt on this property. I've offered these sort of things, but there's a lot that you could let once you're doing enough real estate deals.
They come to you. Those deals will come to you.
They come to you.
To answer another question that someone asked, because it's like, how do you find those type of deals? One, keep your ears to the ground. Let everybody know that you're an investor, so that everybody will try to bring these type of deals to you and say, hey, what do you think about this deal? But when people start seeing you make moves and they know that you actually can execute, they will reach out to you and say, like, hey, my mom bought this house, she passed, or whatever the case are. She honestly just wants to take the money out. She wants to do something with it because she needs money for retirement. And, is there anything that you can do? Is there any way? And, people offer certain things like, can we keep the house? Can we do this? So he gave a great example of how to do that. Hey, you can keep the house, but we're gonna make it our piggy bank for the next few deals that we all do together, and we can generate more revenue from that situation. So Let everybody know that you're an investor. Like shout that from the rooftops. Let them know you're doing deals. And when you do a deal, let them know you did a deal. I just closed a deal. So the more people
Yeah.
hear, okay, wow, all right, all right, and then now they're gonna start asking you questions first. And when they hear that you can answer them, they're gonna say, hold up, hey, I got this situation, I got this thing. I can't tell you how many times I got people call me. Sometimes they want me to help them with their situation. Sometimes they're like, can you help me with the situation? So and it varies. Sometimes it works, sometimes it doesn't. But I've done them before. Like I told you, a lot of times that's how I rebuilt myself after 2008. I was doing deals with the owners of these properties and saying, hey, can I come in and add some money to this? Can I do that? Do you need like a draw? Do you need a draw amount? Right? How much is that next draw? I'll pay the draw. And you get it back on the other thing, but I want a return on investment and I want a piece of the deal, or give me a percentage, or give me a buyout at the end, something, just to get in the deal. So it's plausible, it's possible. Just gotta let people know that you're doing it, and find others, and do what Carl said. Listen, go knock on somebody's door. You might tell them, hey, you don't want to move. How about I clean up your house for you, but I'm gonna cash out refi. You keep the house. I take out this portion.
Yeah.
I mean, there's so many ways to cut a deal. Like it's you just come up with good ideas as long as the numbers make sense.
Most people who follow my channel know that I like Donald Trump as a storyteller and as a public figure, not necessarily as a politician. But there's something that he does really well, and that's self-promote. His name is on everything that he does, right? His name is on everything that he does, and everything that he does, he talks about, and he talks about it in the best way. He's the best to ever do it. No questions asked, right? We're doing wonderfully well. And he doesn't stop talking about what he's doing. And the value to that is important. Everybody who knows Donald Trump knows that he invests in real estate, and it's luxury real estate, and he does well, right? So when you're getting into this, when you're learning about real estate, you should be telling everybody, I'm learning about investing in real estate. When you actually do your first deal, you tell everybody, hey, I'm doing my first deal. Do you want to participate? Everybody's going to tell you to kick rocks. You do your first deal. It goes well. It goes bad. It doesn't matter. Talk about it. I did this renovation. It came out well. It came out bad. This is what I learned from it. Keep talking about what you're doing. Eventually, people who've been just kind of listening in the corner, they might talk about you to somebody else. It's so crazy how you promoting yourself leads to the potential connection years down the line. If you don't do that, then nobody knows what you're doing. Nobody's going to even say, hey, I heard you talking about this. I heard, or even this, just like Gemini said, hey, I'm in this particular situation. You don't know if somebody in this chat is in Baltimore, is a contractor, is that scenario that I described that says, hey, you know what? That sounds exactly like me. Let's connect offline. If you never say that, you never know. And on top of that, somebody you may watch that's not in this live today may watch this video 3 months from now, see that comment, see that interaction, and next thing you know, reach out to you. The world works in that way. So put that energy out all the time. And as you do, things happen. That law of attraction is real, right? It's not just a myth. If you're doing things, things happen, right? So the point is, kind of go out and do.
Yeah. And on that,
let me see if there's any other
note,
question.
I'm going to be a self promoter right now. If you know anybody, you or anybody you know, wants to gain 12+% on their money, there's something else I'm working on as well. Reach out to me, and I will share. I'm putting together a presentation. I'll share it with you, and you let me know what your thoughts are. You like it, don't like it, it's okay. But at least we'll have the conversation, and you have an opportunity to make your money work if you want to, right? At the end of the day. And I will keep saying this. I'll keep doing it because the goal is to end up syndicating very large deals that you guys could be a part of. But we got to start somewhere. So let's start together. Let's start with the 8 unit. Let's start with 12. Let's start with 80. Let's start with 180 and continue to grow from there.
Where should they reach out to you?
Before it's all said and done, we'll get it.
Where should they reach out to you?
So you can, if you go on my Instagram, well, you can comment on my page as well because I'll see it. But if you go on my Instagram page, you can press the email button, which will just send an email directly to me. It'll bring up your email, your email agent or whatever.
What's your Instagram handle?
Harold_Vallisted.
Let me just put that up.
And then my email as well, if you can remember, it's Harold
I'm gonna
at
put it in the
the.
comments so that way they could reference it.
Oh, nice, perfect.
So this is on Instagram.
Yeah,
And what's your email address?
Harold at the nycreguy.com.
Okay, so if you guys are interested in learning more or potentially doing a deal with Harold, just reach out to him. Friendly guy. He's been in the business for years. There's a lot to learn there. He'll give you his time and see where it goes, right?
See, I'm not running multi-million dollar businesses, healthcare businesses like ENTP Life, so I got a little more time to share my wisdom.
I answer. I share time, man.
I'm teasing you, man. Like,
I share time.
listen, just so you guys know, we didn't have what we're giving you coming up. I mean, we had a couple people that spoke into us, but a lot of it we learned on our own through trial and error, through bruising, bumping. Oh my goodness gracious!
This is for you here, Luz Bouvet. Hey, Harold, we have a fully renovated one-bedroom condo on Long Island about to be put on the market that we have had as a rental for the past 8 years. What are some suggestions to reduce/offset capital gains after
Number
sale?
one, hire me as the agent that's selling it. That'd be first. That'd be first and foremost. Then I give you free guidance. I'm just joking around. Yeah, shoot me an email.
But not really.
And then we'll set up a time. Yeah, your husband and I and you can talk about it, and I'll show you some different ways to make that work, depending on what your cost basis is and what that's going to look like coming out. Considering that they haven't changed the 1031 yet, there may be some opportunities to look there. And there's some other things that you can do in regards to putting stuff like an opportunity zone funds. There's so many various ways. I just need to understand the numbers and everything that's involved there. Like I said, what your cost basis is and what you believe that your sale is going to be, which we can look up the comps and things of that nature, and then we could talk about it and figure that all out. So, shoot me an email. We'll set up a time to have a conversation. We could get everybody on the phone, do a Zoom call, and really work through the numbers and see what makes sense. And then, of course, I'll put you my sales pitch to sell the property. But if you have an agent already, don't worry. I can do better than they can. I have a company that'll pay renovation money. So if you need to update it and refresh it a little bit. So little shameless plug, my bad.
Trump is the biggest con artist on earth, a horrible person. He may be, but there's a lot to learn. There's certainly a lot to learn. He self-promotes. He railroaded the political system to win as a hack candidate. He gets tons and tons of free press coverage, which is free promotional dollars by just saying nonsense. So, there's a lot to learn there. Love him or hate him.
I don't know. I don't know if you're from New York. I've watched his ability, and again, I'm not saying he's the nicest person on the planet. I'm not condoning anything that he does in that respect, but I'm trying to teach you what you can learn, the positives that you can learn something from everybody, right? And I watched him have the city change a bus route so that way that his mind you, he licensed his name to these towers on Riverside Drive in New York to have the Trump Towers. But the reason they hired him and they paid the licensing fee because they knew he had the clout to get that bus route moved to come to the west side so people wouldn't have to walk 8 blocks to the subway. So, but by him being able to promote himself and building relationships, even though some of them great, some of them not, he was able to get things done. Again, I don't personally want to go that route, but I do believe in building relationships. I do believe in promoting, not to the place of obsession and narcissism, but I definitely will. Not like I made that mistake when I was younger in my industry. I would promote the building that I was servicing my client, and I never put my name out there. So when I went to get more clients, they didn't know who I was until I said the name of the property or the address, and they're like, "Oh, that's you." I'm like, "Yeah." So I learned that early. I was like, "Okay, that was a mistake I made." So now I did that. That's me. And not to be braggadocious or cocky about it, but just to let you know, I do accomplish things. I do get things done. I do make things happen. So I learned the phrase of own everything. No, own nothing, control everything. and which was something from Rockefeller, but he put that in his book, and that was one thing I remember from The Art of the Deal. So yes, we can learn from even the dumbest and craziest people in the world.
Yeah, and he's not that dumb and crazy, man. It's it's funny
I
that
say dumb meaning in the sense of the stupidity that he does to people.
yeah,
But
I think that's something that as an ENTP personality type, I'll tell you, I could look at the two sides of the coin, right? I don't let my belief system overshadow facts, right? And as much as you may not like somebody or disapprove of someone's behavior or anything like that, there's still factual evidence there that you cannot ignore, right? So, I think it's always in humanity's best interest to remain factual and logical in what you do, right? Because a feeling is not necessarily, or a belief is not necessarily a fact, right? Because you believe something doesn't make it real. But what's real is kind of hard to deny, right? So, when I see people get charged up about political figures or ideologies in a way, I see that they usually kind of separate from a logical framework. And, as much as, like I said, what the person's ideologies are and how they kind of rubbed, things in the U.S. underbelly the wrong way, I can't deny the force that Donald Trump is and has been in the United States, has been in New York City. This is someone that most New Yorkers are familiar with having a track record of executing, whether it's, putting together, building and developing in Atlantic City and going bankrupt and just trying and making some things work and some things failing. I don't know, man. I still have to respect what he's accomplished, as far as helping rezone areas of New York City that were the pits and having developers participate, negotiating tax credits. The guy has done a lot in a freaking lifetime, man. I wish I could if I could achieve half of what Donald Trump has achieved, I'd be pretty happy with myself. Pretty damn proud. It doesn't mean that, as a human being, his ideologies match mine, but there's a lot that I've learned from DT and a lot that I'll continue to learn from his experience. And, I can't deny those things. But anyway, so Dean Barr, sorry.
Yeah, and what we'll do is, because now we're passing, I think, 10 o'clock now, so we'll let this be the last question and wrap it up. But awesome. But this is a good one to end it on.
Yeah, because Dean said that we didn't answer his question, so I'm sorry for skipping you, Dean. Dean Bars, I'm interested in investment properties, but I'm also looking to purchase my first home. How would you suggest I go about this? Which step should I take? Okay, this is a perfect closing question. I'm going to give you my take. Harold will give you his take. It's probably going to be the same. You're a first-time home buyer. That means that you'll qualify for the FHA program. Okay? You want to keep your life simple? FHA, buy a 4-family home, 3 to 4 family, depending on your city and how it's going to be taxed. Okay? If it's going to be taxed as a single-family home and you don't move into the commercial range like you would in New York City, get a 4-family home. Renovate your unit so it's nice and you feel comfortable and happy with what your unit is. Rent out the other 3. That's going to have 3 outside incomes, most likely completely paying for your mortgage and allowing you to cash flow and offsetting your risk, right? So if you want to split between being an investor and getting your first home, that's the route to go, because you're going to put 3.5% down. You're going to get a home that you own, that's yours, but you're going to immediately create income that's offsetting your personal expenses, probably cash flowing, is going to allow you to save up, gain experience, and get more money to do your next deal. Maybe the next one is your house, right, that you live in. You get another, primary residence. You could do that one as a conventional loan for 5% down. Is going to be your primary residence. It'll qualify. Change your property type. You no longer want a 4-family. And now you have your investment property, the still 4-family, now 4 people renting, still cash flowing, still paying on the mortgage, and you have your own homes. Take advantage of the first-time home buyers' low down payment get a multifamily. The more units, the better. And that's how I would start if I were you.
And
Harold?
listen, even looking to, I mean, including that, looking to NACA, which will give you almost 100% financing and low interest rates. You can buy down the interest rate, could be down to like damn near nothing. So but it takes some time. You gotta go to the seminar. They do a webinar now online, and then you deal with a counselor. They make sure your debt to income is good, and then once they approve you, you have this. They'll close. Like it's either Bank of America, or Citibank that's going to close the loan. You just got to find the property once they approve you for it. And house hacking is the absolute best way to start as an investor. Um, a lot of people want to flip. They want to, I'm like, if you don't own anything, go house. I promise you, if I could start all over again, I would have started buying for the 4-3-2-1. I would have bought a 4-unit in Brooklyn, then moved to a 3-unit, then to a 2-unit maybe in Queens, and then buy my one family in Jamaica Estates or Holliswood. And that'd have been my, and then I'd have used that capital to build the empire from there. I didn't understand that. I didn't understand house hacking back then. It was actually Carl who put me on because he accidentally found out about the FHA 203K loan through a grant seminar. You know what I mean? So it's crazy the things. That's why you got to expose yourself to different investors and different people because you're gonna learn different things. But if you want to start and you don't own it, and you're looking for your first home, house hack, please do that. That is the number one way to get into investing in real estate and building up your portfolio.
Yeah, and it's also going to teach you just the mechanics of what goes into a deal. Because at first, like the first time that you're buying a house, all of it is foreign, right? The language is foreign. Getting a mortgage is the first time but once you go through it and you actually sign and you're like, okay, this is it, it's done. Then the next time it gets quicker and quicker and quicker. Everything makes more sense. So, like I said, you have multiple
writing
units,
leases, understanding being a landlord, all those things, paying, having maybe creating an LLC, which I tell people you can't do it because you own an FHA. The deed has to be in your name, but you can run the management of the property through your LLC. So now you can build business credit. You can do different things. And this is all from house hacking, from owning a house. So I promise you, house hack, use that to your advantage. Use the system that is allowing you to do that and make it work, especially now. I mean, obviously competition is fierce, but you can do a 2 or 3K loan, find that listing that's been sitting there for 30, 40, 60 days. There's a reason why it's been sitting there. Somebody doesn't like it or people don't want it, but it might be perfect for you because you got the 2 or 3K loan and you can go fix it, or Fannie Mae home style loan, which is another renovation loan that you can do from a conventional standpoint. So, take advantage of these programs. NACA, any one of these things to get you in the door, take advantage of it. Do not buy one family first. If there's anything I ever listen to us, if you're buying your first house, buy a 4-family if you can, if it's in that area, or 3-family or 2-flat. And even if your husband or your wife is like, no, but I don't want to live with nobody, for 1 year. All you got to do is for 1 year. 12 months goes by really quick. I promise you. Look what happened this past year. It can go by really fast. So, by the way, just so everybody know, we're in the middle. We're past the middle of May. So, this 1 year, I can sacrifice 1 year to start your real estate portfolio. All right. So, hopefully everybody learned something today. And my Instagram folks, thumbs up, hands up. I see some hearts coming through. I appreciate you guys staying with me. I know this was weird with the 2 screens, but I wanted to make sure everybody was getting an advantage, taking advantage of this, and wouldn't know to go on YouTube and such. So maybe I'll do this more on YouTube once
it's good. You chop it up with people. You get different points of views. Your following gets to hear different voices. That's why I like to do them. I like these collaborations. So once again, thank you guys for joining me here at ENTP Live. If you're not already a subscriber, hit that subscription button, like this video, make your way on over to Harold's YouTube page or YouTube channel. So it's at Harold, just like in the title, at Harold J. Valliston. He talks about exclusively real estate. He's not as scatterbrained as me. So if you really are interested in real estate, definitely check out his channel. Follow him on Instagram. A lot to learn there. Thank you, Harold, for taking the time out and joining me on this. Thank you. Instagram
Absolutely.
folks for sticking around.
About investing with me, doing deals with me coaching you through a deal, whatever those things in real estate. Feel free to reach out to me. I'm happy, and I have testimonials to prove it. I got people who bought if their mother a house, themselves a house. So I appreciate that, and I appreciate everyone who follows us and shares our information. Make sure you share this live, share the YouTube, share everything. Don't be selfish with this information, folks. Share. Don't be selfish. Don't be selfish. All right.
Don't be stingy with those likes either. Take care.
Exactly. Please, yeah. Click. I see 5 likes on my page. Yo, go over there and go like everybody who's on this. Go like that over there. And I'm gonna tell everybody to do it on Instagram again too.
Awesome. Thanks, Harold. Man, have a good night.
All right, brother. As always, it's always a pleasure. Have a good one.
Take care.